There's a moment, usually quiet, almost unremarkable, when something in your financial life begins to shift. It's not dramatic, it's not flashy, there's no big celebration. But one day, you open your account and you realize money showed up. Not because you worked extra hours, not because you chased another opportunity, but simply because you owned something. That moment is where many people begin to understand the quiet power of dividend investing. And if no one has ever explained this to you in a way that actually feels real, not just numbers on a screen, then this is exactly where we start. Because dividends aren't just about income. They're about ownership, patience, and building a life where your money begins to participate in your future, not just react to it. Let's begin with the foundation. Dividend investing, at its core, is beautifully simple. When you buy a stock, you're not just buying a ticker symbol or a number that moves up and down. You're becoming a part owner of a real business. And some of these businesses, especially mature, stable ones, choose to share a portion of their profits with their shareholders. That payment is what we call a dividend. Think of it as a quiet acknowledgement. You trusted us with your capital. Here's your share of what we've built. And unlike stock prices, which can feel unpredictable and emotional, dividends often carry a different tone. They're steady, intentional, sometimes even reassuring. Now, not every company pays dividends. In fact, many fast-growing companies don't. They reinvest every dollar back into expanding the business. And that's not a bad thing. It just reflects a different stage of growth. But dividend-paying companies tend to be different. They're often established, profitable, predictable. Businesses that have moved beyond survival and into sustainability. And that matters, especially if your goal is not just growth, but income and stability over time. Let's make this tangible. Imagine you decide to invest in a company like Coca-Cola. This is not a startup. It's a global brand that has existed for decades, quietly generating revenue across continents, cultures, and generations. When you own shares of a company like that, you're stepping into a system that has already proven it can endure. And Coca-Cola, like many companies of its kind, pays dividends regularly, typically every quarter. So every 3 months you receive a payment, not because you did anything new, but because you continue to hold ownership. And over time, something subtle begins to happen. That consistency starts to change how you think about money. Now, early on, many beginners get confused by two terms that show up everywhere: dividend amount and dividend yield. They sound similar, but they tell you very different things. Let's slow this down because this is one of those small distinctions that can completely change how you evaluate investments. The dividend amount is the simplest place to start. It's just the actual cash you receive per share. If a company pays $1 per share annually and you own 10 shares, you'll receive $10. That's it, no complexity. It's the tangible part, the part you can point to and say, this is what I earned. And there's something grounding about that, especially in a world where so much of investing feels abstract. But then there's dividend yield, and this is where perspective comes in. Dividend yield isn't about how much you get, it's about how efficiently your money is working. It's a percentage that compares the dividend to the stock's price. In other words, how much income am I getting relative to what I paid? And this matters more than most people realize, because two people can own the exact same stock, receive the exact same dividend, and still have completely different outcomes. One might have bought at a lower price, capturing a higher yield. The other might have entered later, accepting a lower yield. Same company, same dividend, different efficiency. And that idea, efficiency, quietly becomes one of the most important concepts in long-term investing. Because over time, it's not just about what you earn, it's about how well your capital is positioned to earn. Now here's something I wish more beginners were told early on. A high dividend doesn't automatically mean a good investment. In fact, sometimes it can be a warning sign. If a company is paying unusually high dividends, you have to ask, is this sustainable? Or is the market signaling that something underneath the surface isn't as strong as it appears? This is where thoughtful investing begins, not just accepting numbers, but asking better questions. So how do you know if a dividend stock is actually reliable? Not just today, but over the long term. This is where history becomes incredibly valuable, because companies leave patterns behind, and those patterns tell stories. The first thing you want to look at is consistency. Has the company paid dividends regularly? Have there been interruptions, reductions, or skipped payments? Because consistency isn't just a statistic, it's a reflection of discipline, management quality, and financial health. A company that protects its dividend often understands something deeper, that investors are trusting them not just for growth, but for reliability. Then there's growth. Has the company increased its dividend over time, even slowly? Because small, consistent increases can be far more powerful than large, unpredictable ones. They suggest that the company is not only stable, but improving. And that's the kind of quiet progress that compounds over decades. There's actually a name for companies that have demonstrated this level of consistency. They're called dividend aristocrats. And these are companies that have increased their dividends for at least 25 consecutive years. Think about that for a moment. 25 years of not just surviving, but steadily growing their ability to reward shareholders through recessions, market crashes, economic uncertainty. That kind of track record doesn't happen by accident. And then there's an even smaller group, dividend kings. These are companies that have done it for 50 years or more, half a century of consistency, which means they've navigated multiple economic cycles and still maintain their commitment to shareholders. Companies like Coca-Cola and Johnson & Johnson fall into this category. And while no investment is ever completely risk-free, these histories offer something incredibly valuable: perspective. Because when you zoom out and look at decades instead of days, something shifts. Short-term noise becomes less important, and long-term patterns become more meaningful. Now, all of this leads to one of the most powerful ideas in dividend investing, and it's something that many people overlook at first. Dividends are not just income, they are fuel. Fuel for something much bigger. Because what you do with those dividends matters just as much as receiving them. And this is where a simple tool, often underestimated, can completely transform your results. It's called a dividend reinvestment plan, or DRIP. And the idea is almost deceptively simple. Instead of taking your dividend as cash, you reinvest it automatically. Your broker takes that payment and uses it to buy more shares of the same stock. No effort required, no decision fatigue, just quiet, consistent reinvestment happening in the background. And at first, it might not feel significant. The amounts might be small, almost unnoticeable. But over time, something extraordinary begins to happen. Those additional shares start generating their own dividends, which then buy more shares, which then generate more dividends. And slowly, almost invisibly, a compounding engine begins to build. This is the part of investing that doesn't get enough attention because it's not exciting. It doesn't create instant results, but it creates something far more valuable: momentum. And momentum, once established, becomes incredibly difficult to stop, because now your growth is no longer dependent only on what you contribute. Your investments are beginning to contribute alongside you. Now, let's slow down and really sit with this idea for a moment, because compounding, true compounding, is not loud. It doesn't announce itself in big, dramatic milestones. Instead, it works quietly, patiently, almost invisibly at first. And that's why so many people underestimate it. When you reinvest your dividends through something like a DRIP, you're doing something profoundly important. You're choosing future growth over immediate gratification. And that's not always easy, because there's a natural temptation to take the cash, to spend it, to feel the reward right away. But when you reinvest, you're essentially telling yourself, not yet, I'm building something bigger. And over time, that decision begins to compound, not just financially, but psychologically. You start to shift from thinking like a consumer to thinking like an owner. Let's make this real. Imagine you own shares in a company that pays you dividends every quarter. At first, maybe those payments are small. Maybe it's just enough to notice. But instead of withdrawing that money, you reinvest it, quarter after quarter, year after year. And slowly, your number of shares increases, which means your future dividends increase, which means your reinvestments get larger. And suddenly, what started as a small stream begins to feel more like a current. This is what people mean when they talk about a snowball effect, not because it's fast, but because it builds on itself. And once it gains enough size, it becomes incredibly powerful. Now, there are a few practical reasons why many investors choose to use a DRIP. First, it removes friction. You don't have to decide when to reinvest. You don't have to log in, place trades, or think about timing. It just happens. And sometimes simplicity is one of the most underrated advantages in investing. Second, it often comes with no additional fees, which means you're reinvesting your dividends fully without losing a portion to commissions. And over long periods, even small cost savings can make a meaningful difference. Third, and this is the most important, it reinforces consistency. And consistency, more than almost anything else, is what drives long-term success. Not perfection, not timing the market, but showing up again and again with the same disciplined approach. Now, I want to pause here and address something honestly. Dividend investing is not a shortcut. It's not a way to get rich quickly, and it's not going to create dramatic overnight results, but that's actually part of its strength. Because what it offers instead is something far more sustainable, a framework for building income over time, without relying on constant decisions or emotional reactions. And in a world where financial information is often overwhelming, where there's always another strategy, another trend, another must-buy stock, there's something incredibly grounding about a simple, repeatable approach. Buy quality businesses, hold them, reinvest the income, allow time to do its work. That's it. And while it may sound almost too simple, the challenge isn't understanding it. The challenge is sticking with it. Because along the way, there will be moments of doubt. Markets will fluctuate, prices will drop, headlines will create uncertainty, and you may find yourself questioning whether you should change direction. But this is where perspective matters. Because if you've chosen companies with strong histories, companies that have demonstrated consistency, resilience, and a commitment to their shareholders, then those temporary fluctuations begin to feel less threatening. You start to see the difference between price and value, between noise and signal. And gradually your focus shifts from daily movements to long-term progress. Now, if you're just starting out, it's important to keep this simple. You don't need a complicated portfolio. You don't need dozens of stocks. You don't need to understand everything all at once. What you need is a foundation. A few carefully chosen companies, a clear understanding of why you own them, and a system, like DRIP, that helps you stay consistent. Because investing at its best is not about constant action. It's about thoughtful positioning, and then allowing time to do what it does best. And over the years, something begins to change, not just in your portfolio, but in your relationship with money. You start to feel less reactive, less dependent on external circumstances, more aware that your financial life is something you are actively shaping, not just experiencing. And that feeling, that quiet sense of control, is one of the most valuable outcomes of all. Now, before we close, I want to leave you with something practical. If you're ready to begin with dividend investing, here's a simple path forward. Start by identifying companies with strong dividend histories. Look for consistency, look for growth, look for resilience. Then begin small. You don't need a large amount of money to get started. What matters is the habit, not the size. Next, set up your dividend reinvestment. Whether you're using an app like WealthSimple or another brokerage, the process is usually straightforward. Find the dividend reinvestment option, turn it on, and let it work in the background. And finally, give it time. Because the real power of this approach doesn't show up in weeks or months. It shows up in years. Years of consistency, years of reinvestment, years of allowing your investments to quietly compound. And one day, much like that moment we talked about at the beginning, you'll look at your account again and you'll notice something. Not just that you're receiving dividends, but that they've grown, that they're more meaningful, more substantial, more reflective of the time and patience you've invested. And in that moment, you'll realize something important. This wasn't about chasing quick wins. It was about building something steady, something reliable, something that continues to work even when you're not thinking about it. That's the real power of dividend investing, not just income, but independence. If this helped you understand dividends in a deeper, more practical way, take a moment to engage because it helps more than you think. And if you're following along, comment something simple like dividend or drip, just to lock in what you've learned today. And if you're ready to take the next step, the next video will walk you through exactly how to start investing and what to look for in today's market conditions. Because understanding is one thing, but applying it, that's where everything changes. I'll see you there.